Hello, everyone, and welcome to our 2020 election results and the market presentation. And what I'm going to be going through today is the market and economic effects and what we see coming based on the 2020 election results. And I know what you're thinking. The first thing is the 2020 election is not totally in the books yet. We still have some Senate races to go through. That is true. So what we're working with today is just what we know today and what we have projected today from the major media outlets. And that would be, we are projecting a Biden presidency, more than likely a Republican controlled Senate, although that has not been decided yet, and a Democratic controlled House. So just up front, what the assumptions are for today's presentation. We're going to be using some information from a few different firms, one being Moody's. I encourage you to pause the screen and read through the disclosure about Moody's and kind of who they are and what they do, as well as JP Morgan. So a couple different places we're gathering some of the numbers from, but I will be going through them. So as I mentioned, we're looking at a Biden presidency. The media has declared Joe Biden president-elect as of right now, which means he will take office on January 20th, barring any unforeseen event. So given that, and given his platform and what he would like to accomplish, where are we going to be at? Or what are we looking ahead toward? Because where we actually end up, a lot remains to be seen, right? Before we even get started with the impacts here, I included this slide because I think it's funny. And that is a bull market, a bear market, and a kangaroo market, to coin a new type here, right? And the kangaroo being a measure of that up and down volatility. So just to set the table, we may be closer to that kangaroo market than we are to a bull or a bear right now. None of these are official terms necessarily. It's just kind of a way of looking at what's been going on. So what I want to get into now are the different probabilities. Of course, this slideshow was created before the election, right? So we had to get it all approved and get all our information together. So we were looking at a few different scenarios. Obviously, the one that I've just mentioned that we're going to be talking about today is scenario number one, which Moody's thought was the highest probability. So this is their baseline from August. And in the number one scenario, it would be challenging. And by the way, again, that's Biden as a president, Republican-controlled Senate, and Democratic House. So it would be challenging in that environment for Biden and the Democrats to implement an agenda. We would see continued use of executive orders, as well as continued congressional stagnation. Some chance legislation that includes both deficit finance government spending increases and tax cuts could or would get through. That's what Moody's was saying back in August. And that's where, just to add, kind of our feelings here, we do see, if the Republicans manage to hold on to the Senate, a degree of stagnation, a degree of Biden coming in with some plans and those plans not being able to be executed necessarily to the full extent that he had planned or that he would like, purely because of a partisan divide and just the rigors of getting legislation from the House to the Senate to the president's desk. It's got to go a long way before that happens. So that will sort of tamp down some of the expectations. But what we're going to be going through here, this graph that I'm showing you is actually, and this was actually for a Democratic sweep. Now, this graph that I'm showing you here, Biden wins, Senate is controlled by Republicans. That's the scenario here. So what are we expecting? I encourage you to read through this. You can pause and look at the graph. These are projections here. But let me kind of break it down for you. So the point here is that we're seeing modest growth. That is what we're looking at in this baseline scenario here. So it's difficult to see a political path to big changes in tax and government spending policies. They may have some wiggle room using, the budget reconciliation process, and we can get into all the minutia there. But given prospects that the economy will still be struggling next year in its recovery from the pandemic and less concern over budget deficits, given, the Fed, who has made this commitment to maintain very low interest rates, almost zero interest rates for some time, there might be a way to strike a deal on some more infrastructure or social spending in exchange for possibly tax cuts to the middle income households. That would be an area where we could see them working together. Um, One of the other things is executive orders. So Biden will use the authority of executive orders to potentially unwind some of the trade and healthcare and even immigration policies that the Trump administration had put into effect over the next few years. So I'm speaking broadly, but that's really where we're at this point. We can talk about their intent, but obviously what actually ends up happening over the next 4 years could be very different from what their intent is. That's always a disclaimer, right? Um, so to be sure, there's no prospect that all of Biden's proposals would get through the legislative process and into law fully intact, so to speak, right? Fully adhering to the original vision. And the policies could quickly change on either side of the election depending on different economic and political circumstances. Um, it is instructive, however, to look at what they've proposed. So that's kind of what we're doing here. We're looking at what's been proposed with the knowledge that, of course, that could change. Of course, given different economic or political realities, those things could be different. Just to go on to the second part here, I talked about interest rates. This slide highlights the fact that we anticipate interest rates will stay lower for longer, as well as we anticipate the budget deficit will increase. And that was some of that potential infrastructure spending I talked about. So those are two things to watch out for. The Biden tax plan. So very, very briefly, this is the proposed plan again. So I want to make a distinction there. We're seeing we need to finance increased government spending. That's the whole impetus behind the tax program, right? So the goal here is that low and middle income households benefit from Biden's economic proposals. That is, they receive their tax bills remain roughly the same, but education, healthcare, housing, and other social programs get increased funding from the increased revenue that is then generated from higher income households and corporations. So those would be the two groups that would potentially pay more in taxes. And what we'd watch for from a market perspective there is potentially that especially that corporate tax could weigh a little bit on stock prices and dividend income. And what I mean by that is simply if corporations are paying more in taxes, there's less money that gets kicked out to shareholders, right? So that's where we expect high income and wealthier households, pay meaningfully more in taxes under Biden's policies, as do corporations. So that's one thing we're watching for. Again, this is as proposed. We will see what actually gets ended up being implemented. It could be a more tamped down version of this. Trade. I briefly touched on trade via that executive order, but one of the things we look for here is a potential. Biden has talked about the possibility of recommitting to a modified Trans-Pacific Partnership free trade agreement with tougher labor and environmental provisions. Okay, let's break that down. What is the Trans-Pacific Partnership, or so-called TPP? And this was something that the Obama administration had started working towards, and the Trump administration had decided that was not the direction they wanted to go. Well, the TPP is not a trade deal with China. That's the big key here. The TPP is actually a deal between the U.S. and other Pacific Rim nations outside of China or other than China. And why that might be important is it's because making a free trade agreement with the nations that surround China or are its next door neighbors, but not China, can help you exert some influence in the economic region, right? If we're making trade deals with Japan and Indonesia and Australia and all those other Pacific Rim nations, or many of them, I shouldn't say all of them, but many of them, that is a way to benefit them and to exert a little bit of pressure on China to kind of come to the table and grant some of these trade wishes that we're trying to do, the labor, the environmental, the intellectual property, all of those different aspects that China has been sort of lax on, or that we've been in tough negotiations over. Trump, as it says there, withdrew from the TPP with one of his first executive orders. If it was done by executive order, it could be undone by executive order. So that's, one of the things we're watching for here. Government spending. So this is fairly black and white according to the plans that have been put out there. Biden plans to substantially increase government spending. Money will come from corporate and wealthier folks' taxation. You can tell that's basically right off the stump speech, right? Wealthier folks' taxation. proposal calls for $7.9 trillion to go toward creating jobs, infrastructure, healthcare, education, and the social safety net. So we talked about this a little bit with taxes, right? But the idea here is that infrastructure, education, social safety net, healthcare, and with a bulk of that spending slated to actually happen during his term as president in an effort to generate more jobs, to return the economy to full employment as quick as possible. This is how we get out of the recession, the pandemic recession. That's the playbook that they're putting into play. What happens based on these proposals, again, remains to be seen. That's something we're going to watch very closely. However, an increase in government spending, even with the tax plan we talked about earlier, we do anticipate will add to the debt and the deficit. So the deficit, right on cue, right? Biden's proposals will result in increased federal government deficits and debt load. And $2 trillion greater debt load during the first term, $2.6 trillion over the decade. Publicly traded debt as a percentage of GDP. GDP is just, it's gross domestic product is what the acronym stands for. And it's just a measure of the overall productivity of our country. So right now we are over our GDP in debt, and we expect that to continue. So we're increasing our debt load. There are a few things to watch out for that. But right now, it doesn't seem like there's much of an alternative other than deficit spending. There are other options, but as far as what's going to get us out of this recession, that is the Biden administration or President-elect Biden's plan to benefit our economy as we're coming out of this pandemic recession. This has been the underlying theme the whole way through, right? Divided government, split Congress. We expect only modest differences in enacted policy and the economic outlook with a split Congress, regardless of who is president. Again, this is written, before we knew who the winner was going to be. So with all that stuff I just went through, remember that what actually happens may be significantly reduced from an action standpoint or from a aggressiveness standpoint than what the plans actually are. And by the way, Biden knows this. I mean, this is not a secret, right? That if you have a divided Congress, it's tougher to get things done. You have to compromise more. You're not going to get all of what you want, very likely. Everybody knows this. So it's just a question of where things are going to shake out in the end. And that's something we're watching very closely. As you can see from these charts, and I love this graph because it's kind of got a hidden meaning, or not hidden, but a secondary point. As you can see from these charts, economic growth as measured by GDP, so that's the economy, and that's the lower half of this graph here, tends to increase more under a Democratic control, and that would be executive, presidency, Senate, and House. That's what we mean by total control there. So the economy tends to increase under complete Democratic control as opposed to full Republican control. However, the opposite is true of the S&P 500, which is the stock market, right? So as Republican control tends to lead to a better return in the stock market. So the biggest takeaway for me is actually neither of those 2 points, though, right? It's that 62% of the time, there's a divided government. That's what we're in right now. And as you can see, and feel free to pause the screen and look at these graphs more closely, the economy and the market still grows even when we have a divided government on average, right? On average, not like clockwork, but on average. So that's what this is telling me. So it's, yes, there may be gridlock, there may be stagnation in the government, but we still expect the market and the economy to grow in the long term. That's at least historically what the precedent has been. This chart is really interesting. The one on the right isn't as interesting. That was kind of poll data before the election. But the one on the left is the one I want to draw attention to. And if we take a look at the chart on the left, we can see some of the policy agenda items for the candidates, as well as the potential impact that might follow from these actions. So, Biden, we're looking at tax hikes. We're looking at infrastructure spending increases, moderate protectionism versus greater protectionism under the current administration. We may, instead of trying to repeal the Affordable Care Act, we may try to enhance it and include a private option. Tougher regulations on energy and related to climate change. We could see that happening. Regulation will likely increase. That's been a Democratic Party platform for a while now. a greater Fed independence, Federal Reserve is what Fed stands for there, and potentially a looser stance on immigration. That's what we're looking for. So those are the things that we are watching on your behalf. How those items may impact you specifically is a place where we need to talk to you individually, right? I can't, say, well, one size fits all blanket statement here to tell you what you should be looking out for. That's where you need to get in contact with us. So this is just a helpful reminder. This really doesn't have much to do with the election at all, but after all the information we've gone through today, I think this chart is kind of helpful, right? Remember, there are some things in your control and some that are out of your control. Whatever policies enacted by the government, whatever the market does in reaction to those policies, right? Those items are largely out of your control. What we can control is how we react to things, right? And specifically, how your particular situation may fit with the larger world of finance and investments that exists beyond your accounts. That's what we can control, how you react. So that's where we come in. That's where you call me. That's where you call Jeff or Eric or Michael or whoever you work with. And you say, hey, I'm hearing about this thing. What do you guys think? And that's where we kind of tailor our advice to fit your specific situation. Finally, and I'm sure you've seen this chart before if you've logged on to one of our calls, but this is one of my favorites. I always come back to it. What we're looking at here is the year-end performance of the S&P 500, that's the stock market, 500 largest stocks in the stock market, represented by the bars on this graph. So that's where it ended the year. And the intra-year, I-N-T-R-A, declines in the market, represented by the red dots. So what this means is that as of August 28th, which is when this data was pulled, obviously we're a little bit past that now, but the point is still true, and this goes all the way back to 1980. As of August 28th, 2020, when this data was recorded, the market was up 9%. That's that 9 you see in that darkened bar graph or bar chart on the very right-hand side of the screen. However, at one point in the year, the market was doing much more poorly, reaching a down point of minus 34%. That's that red dot underneath the bar that says 9 above it. So what you can see from this chart is that sometimes there's a very large difference between where the market is at its lowest point in a year and where it ends up on December 31st of that same year. I mean, you can see it going all the way back to 1980 here. So the point is, markets may sell off, but that doesn't mean they will stay down for an extended period of time. We always recommend talking to us or your advisors about what to do in your particular situation. So just because we see a big sell-off in the market, a big drop, does not mean that things won't recover. And as you can see, most of these bar charts are ending the year positive. So it's just something to keep in the back of your mind. At this point, we'd like to open it up for questions. And if you don't feel comfortable with questions, we would encourage you to email us. And that's my email and then Lauren's email as well at the bottom of the screen there. So please jot those down. If you've got questions about this slide, if you've just got questions about investing and you're looking for someone to talk to, we can help or point you in the right direction. So please get in touch if you need anything. And I want to thank everybody for attending. I know it's been a wild ride this year, and things are still going to keep going, but I hope this brings you a little bit more clarity on the kind of what we're looking for in the coming year, the coming 4 years, and kind of sets the table for the market, the economy, and how the political realities might affect those two things. So thank you, everybody, for coming, and we'll see you next time.